Global markets over the last few weeks, you might have felt something shifting, something subtle at first, but then it started getting louder. Bond markets suddenly became jittery. Yields spiked. Analysts began using words they normally avoid. Words like meltdown, contagion, liquidity crisis, systemic danger. But today, that quiet background noise turned into a global alarm. Because Japan, yes, Japan, the country long known for its stability, its discipline, its calm financial behavior, just triggered a shock that is now rippling across every major bond market in the world. This is not speculation. This is not prediction. This is happening in real time. And if you understand how global debt works, then you understand why experts are calling this the most dangerous moment in decades. Let's break down exactly what happened. Japan's bond market was never supposed to break, but it just did. For more than 30 years, Japan has held the reputation of having the world's most stable bond market. The Bank of Japan kept interest rates near zero or even negative for years. The government kept borrowing and borrowing and borrowing, relying on the fact that investors felt safe buying Japanese bonds. It became one of the core pillars of the global financial system. Japan's debt-to-GDP ratio is the highest in the developed world, over 230%. And yet, nothing ever happened. The system kept going, until now. In the last few days, Japanese government bond yields, especially the 10-year, the benchmark for the entire economy, spiked to their highest level since 2007. Think about that. A country that has been artificially holding interest rates down for decades suddenly saw its bond yields jump like a pressure cooker releasing steam. Traders immediately noticed something unusual. The sell-off wasn't coming from foreign speculators. It was coming from inside Japan. Domestic banks, domestic insurers, domestic funds. The same institutions that always supported the government's massive debt are now stepping back. And the world started asking, if Japan can't support its own debt anymore, who will? The trigger, Japan's new leadership just made a massive gamble. Japan's new Prime Minister, Sanae Takaichi, announced a huge fiscal expansion plan. More borrowing, more spending, and more aggressive government intervention. In a normal economic environment, maybe this wouldn't worry investors. But right now, it sent shockwaves through the financial world. Why? Because the timing is catastrophic. Japan is trying to issue even more bonds at the exact moment when demand for those bonds is collapsing. Recent bond auctions for 20, 30, and 40-year JGBs saw weak or historically low demand, a major warning sign. It's simple economics. When supply goes up but demand collapses, yields explode higher. And in a country with wide over $300 trillion in government debt, rising yields can quickly become deadly. The Bank of Japan is no longer the backstop. For decades, whenever Japan needed someone to buy its bonds, the Bank of Japan stepped in, unlimited, unrestricted, unquestioned. But the BOJ cannot do that anymore. Inflation has returned to Japan, something the country hasn't dealt with in nearly 40 years. The central bank has been forced to step back from ultra-loose monetary policy. They've been reducing bond purchases, they've been trying to normalize interest rates, and now, just when Japan needs its central bank the most, the BOJ is signaling that it won't rescue the bond market the way it used to. This is the first time in decades that Japan's government is being forced to face the bond market without guaranteed support. And the market is reacting violently. The global contagion begins. Here's where the story becomes truly global. Japan is not just another country with a lot of debt. Japanese institutional investors, pension funds, banks, insurance giants, hold over $12 trillion worth of assets globally. That includes U.S. treasuries, European bonds, corporate debt, emerging market debt, and more. If Japanese yields rise enough, these investors will start pulling money back home, not because they want to, but because they'll be forced to. Their domestic losses will become too severe. Their portfolios will need to rebalance. Their regulators will pressure them to stabilize Japanese markets. This means trillions of dollars could suddenly start flowing out of global markets and back into Japan. And guess what happened right after Japan's yields spiked? U.S. treasuries fell, European bonds sold off, emerging markets felt pressure. The volatility index jumped. It took only minutes. That's how interconnected the system is. Japan moved, and the world trembled. A $12 trillion crisis is emerging. The reason analysts are calling this a 12 trillion shock is because of how much capital Japan controls worldwide. If Japanese institutions panic even a little, global liquidity could vanish almost overnight. Imagine. Credit markets freezing, bond yields rising everywhere, currencies swinging violently, stock markets correcting sharply, real estate markets losing momentum, companies struggling to refinance debt, governments seeing borrowing costs spike. All because the world's most stable bond market suddenly became unstable. Japan was never expected to trigger a crisis, but here we are. And experts now believe this may be the first phase of a global debt meltdown. Why it matters. The world has never been this vulnerable. This is happening at a time when global debt is at an all-time high. The US debt just crossed $34 trillion. China's shadow banking system is under meltdown. Europe is facing recession and fiscal strain. Emerging markets owe massive amounts to foreign lenders. Corporate debt worldwide is reaching dangerous levels. Japan's sudden instability is like pulling a brick out of the bottom of a tower. If that brick moves, the entire tower can collapse, and right now, that brick is shaking. And why the world is suddenly terrified. Because Japan's bond crisis didn't stay inside Japan. It didn't remain a domestic issue. It didn't remain a local correction. Instead, within hours, it morphed into a global liquidity crunch that economists have been warning about since the pandemic era began. And the reason it spread so quickly comes down to one uncomfortable truth. The entire modern financial system is built on cheap debt. And Japan was the last safe place keeping that debt cheap. Now that pillar is cracked, and the shockwaves are everywhere. The chain reaction begins why the world reacted. Within hours, global markets weren't supposed to panic this quickly. Normally, when a country's bond yields rise, investors wait. They observe. They try to understand whether the movement is temporary. But with Japan, there was no hesitation. Because investors know one thing. When Japan's yields move, everybody's yields move. Here's why. For decades, Japanese investors, banks, pension funds, insurance companies have been major buyers of foreign bonds. They've supported U.S. treasuries, European government bonds, corporate bonds across the world, mortgage-backed securities, and emerging market debt. Japan played the role of the world's quiet stabilizer. Whenever global markets panicked, Japanese buyers stepped in. Whenever yields rose overseas, Japanese institutions absorbed the pressure. Whenever liquidity tightened, Japan eased it. But now, Japan is the one panicking. The first domino, insurers start pulling back. Let's talk about the biggest players in Japan's financial system, insurance companies. They hold massive amounts of foreign debt, especially US and European bonds. But in the last 48 hours, analysts reported that Japanese insurers are cutting new purchases of foreign bonds, shifting reserves back into domestic JGBs, reducing duration, selling long-term bonds first, preparing for further domestic yield spikes. This is not normal behavior, this is crisis behavior, and it's happening because insurers are required by law to protect their solvency. Rising domestic yields mean they must rebalance portfolios. If they don't, they risk massive paper losses that could weaken the entire sector. So what happens when they pull back? A vacuum forms, a $12 trillion vacuum. And every bond market that relied on Japanese money instantly loses one of its biggest buyers. The US feels it first. And hard America didn't expect trouble from Japan. Not now, not when the US itself is struggling with massive debt issuance, rising deficits, and stubborn inflation. But the moment Japanese institutions slowed their buying and prepared to repatriate capital, US Treasury yields started rising again. You might think, what's the big deal if yields rise a little? But here's the truth. In a world drowning in debt, even a small rise in yields can create a tsunami of refinancing costs. Higher yields mean higher mortgage rates, higher borrowing costs for companies, higher government interest payments, higher credit card and loan rates, lower consumer spending, falling stock prices. It becomes a chain reaction. And this is why the US reacted instantly when Japan stumbled. Because Japan isn't a small investor. Japan is the single largest foreign holder of US debt. If Japan pulls back even 5% of its holdings, it can destabilize the $27+ trillion US Treasury market. And markets saw that possibility immediately. Europe enters panic mode. While the US was reacting to Japanese sell pressure, Europe was dealing with its own problems. Recession risks, political instability, high energy costs, unsustainable debt in Italy, France, and Spain. So when Japan's yields spiked, European bonds sold off sharply, especially in countries already labeled high risk. Italy's borrowing costs jumped in minutes. France saw significant bond outflows. Germany's Bund yields rose sharply as investors demanded higher returns. Europe is extremely sensitive to global financial shocks. And Japan just delivered one. The hidden trigger behind Japan's meltdown: inflation, population, and policy collisions. Japan's crisis didn't come from one source. It came from three sources, striking at the same time. 1. Inflation returned. After 40 years, Japan lived in deflation for decades. But now inflation is persistent, sticky, and dangerous. Once inflation rises, interest rates can no longer stay at zero. The BOJ was forced to tighten policy. That instantly changed Japan's financial stability model. 2, aging population, Doshikawa's collapsing domestic demand. Japan's population is shrinking and aging faster than any major country. That matters because pension funds have higher liabilities, fewer workers to support the system, savings pools are shrinking, domestic consumption is weakening. A weak demographic profile means the government must borrow more, but has fewer buyers for its bonds. 3, policy shock. Under new leadership, Prime Minister Sanae Takaichi's aggressive fiscal expansion came at the worst moment. Investors expected caution. She delivered the opposite. Larger spending packages, bigger deficits, faster borrowing, ambitious political goals. This is why the crisis accelerated. This was not gradual. This was policy gasoline poured on a burning market. And then comes the worst part. The carry trade starts to reverse. For 20 plus years, traders used the yen carry trade, borrow money in Japan at near zero interest, invested in higher yield countries, pocket the difference. This supported US stocks, Indian markets, crypto, emerging markets, corporate debt, global tech companies. But when Japan's interest rates rise, the carry trade unwinds violently. Traders must buy back yen, sell foreign assets, reduce risk, unwind leverage. This creates global selling pressure, and that's exactly what markets saw. Tech stocks dipped, emerging markets weakened, crypto saw volatility, bond markets tightened. This is the true global contagion. Japan sneezes, and the world catches pneumonia. The World Bank and IMF are already issuing warnings. Within days of Japan's yields spiking, major institutions started issuing alerts. The World Bank warned global debt servicing costs are at record highs. The IMF emphasized risks of synchronized debt distress. Financial analysts are calling this one of the most dangerous debt moments of the century. Japan didn't create the global debt problem, but Japan just exposed it, because if the world's most stable bond market can shake, then any country's debt can shake. What you're watching right now is not a local crisis. It's a stress test for the entire global financial system. Japan was never supposed to break. It was the quiet backbone of global debt, the one country everyone thought would stay stable forever. But the moment Japanese yields spiked, the world realized a brutal truth. If Japan can lose control of its debt, then no nation is safe. The US is drowning in record deficits. Europe is cracking under political and fiscal pressure. China's shadow banking system is collapsing from within. Emerging markets are one shock away from default waves. Japan simply lit the fuse, and the next few months will tell us how far the fire travels. Because a $12 trillion repositioning doesn't happen quietly. It doesn't happen slowly. It doesn't happen without consequences. Japan has already forced global yields higher. It has already shaken liquidity worldwide. It has already pushed major economies onto thinner ice than anyone expected. So here's the final question. If this was the warning shot, what does the real crisis look like? And more importantly, how prepared is the world for what comes next?